Silver did not fall gradually, it repriced, and it did so in a matter of hours, not days. That distinction is critical because markets behave very differently when price moves faster than structure can respond. A 2-hour repricing is not a reassessment of fundamentals, it is a forced adjustment. There is simply not enough time in that window for demand expectations to collapse, supply to change, or macro narratives to evolve meaningfully. When price moves that quickly, it reflects pressure inside the system rather than a change in outlook. The immediate reaction was to frame the move as volatility. Headlines focused on magnitude and speed, treating the event as an outlier. But speed is not noise, speed is information. It tells us where tolerance broke first. Markets are built to absorb stress gradually. Liquidity, hedging mechanisms, and positioning buffers exist to smooth adjustment over time. When those buffers are overwhelmed, price compresses the adjustment into a narrow window. That compression is rarely accidental. For professionals and researchers, the key question is not what triggered the move, but why the market was unable to absorb it more smoothly. 2 hours suggests that the system encountered a constraint it could not negotiate around. Silver's structure makes this particularly revealing. It sits on top of a large, leveraged paper market tied to a much smaller physical base. Under normal conditions, that imbalance is manageable because confidence substitutes for immediacy. Participants trust that exposure can be rolled, hedged, or settled without friction. When confidence narrows, that substitution fails. This is where the market appeared unprepared. The repricing suggests that participants were positioned for continuity, not compression. They expected liquidity to remain available long enough to adjust exposure incrementally. Instead, adjustment was abrupt. Importantly, this does not imply panic. Panic produces disorder. What occurred was orderly, but fast. That combination points to forced recalibration rather than emotional reaction. Another overlooked aspect is sequencing. Silver moved before many of the explanations offered to justify the move appeared. That inversion matters. When price leads explanation, it often signals that internal constraints are driving behavior ahead of narrative. This is why focusing on what just happened misses the deeper issue. The more important question is what the market assumed would not happen, and did. The 2-hour repricing exposed a mismatch between how risk was being carried and how quickly it could be unwound. That mismatch does not resolve simply because price stabilizes. It changes how participants behave going forward. If this type of structural analysis aligns with how you follow markets, consider subscribing. This channel focuses on why markets move when they do, not just how much they move. To understand what made silver vulnerable to such a rapid adjustment and why the system struggled to absorb it, we need to examine how liquidity and positioning interacted in the moments leading up to the repricing. To understand why silver repriced so quickly, it is necessary to look past explanations and toward mechanics. The move did not begin with a story. It began with liquidity behaving differently than expected. Liquidity is often treated as a constant. It is modeled, assumed, and relied upon. But liquidity is conditional. It exists only as long as participants are willing to provide it under prevailing terms. When those terms shift, liquidity does not disappear, it retreats. In the hours leading up to the repricing, silver was trading inside a framework built on continuity. Positions were sized on the assumption that exits could be staged, hedges could be rolled, and counterparties would remain active across time zones. That framework works when confidence is broad. It breaks when confidence narrows suddenly. The 2-hour window suggests that narrowing happened quickly. What matters here is not volume, but who stepped back first. In rapid repricing events, the initial move is often triggered not by aggressive selling, but by the absence of buyers willing to intermediate. Once that absence is felt, price must travel further to find balance. Silver's paper market amplifies this effect. Because exposure is layered through futures and derivatives, liquidity relies heavily on balance sheet willingness. When that willingness becomes selective, the adjustment accelerates. Price is forced to do what liquidity will not. This is why the market was not ready. Participants expected time. They expected depth. They expected the usual buffering mechanisms to slow adjustment. Instead, the system compressed it. Importantly, this compression was not chaotic. Trades cleared, markets functioned, but they functioned under stress. The speed of the move reflects how quickly assumptions about liquidity were challenged. Another critical factor is positioning symmetry. When many participants are positioned similarly, even modest shifts in confidence can produce outsized moves. The market does not need new information. It only needs participants to reach the same conclusion at roughly the same time, that risk needs to be reduced. Silver's repricing fits this pattern. The move was too fast to be explained by demand collapse or macro deterioration. It was fast enough to indicate that positioning tolerance was exceeded. This is where narrative lags reality. After the fact, explanations are offered to justify the move. But those explanations are often reverse-engineered. They describe the outcome rather than the cause. The cause lies in structure. When liquidity becomes conditional, markets stop negotiating. They adjust. That adjustment can occur without warning if confidence shifts abruptly. Silver's structure, leveraged paper exposure resting on limited physical elasticity, makes it particularly sensitive to such shifts. This is why the 2-hour repricing matters beyond the price itself. It tells us that the system's ability to absorb stress smoothly was overestimated. It reveals that the margin for error was thinner than assumed. And once that realization enters the system, behavior changes. Participants become more cautious. Liquidity is offered more selectively. Future adjustments require less pressure to occur. To understand the implications of that change, and why it does not simply reverse when prices stabilize, we need to examine how confidence, once narrowed, reshapes market behavior over time. One of the most overlooked elements in rapid repricing events is how positioning interacts with time. Markets are not just priced for outcomes, they are positioned for paths. Silver's positioning going into the 2-hour move was built for continuity, not compression. This distinction matters. Most exposure in modern commodity markets is structured around the assumption that adjustment will be incremental. Positions are hedged with the expectation that price will move within a range wide enough to manage risk, but slow enough to allow decisions to be made. Stops, rollovers, and offsets assume time as an available resource. The 2-hour repricing removed that resource. When time collapses, positioning becomes the vulnerability. Participants who were comfortable carrying exposure under normal volatility suddenly find that their risk management tools are no longer effective. The issue is not leverage alone, it is leverage combined with speed. Silver's market is particularly sensitive to this dynamic because of its layered exposure. Futures, options, structured products, and hedged physical positions are interconnected. When price moves too quickly, those layers stop functioning independently. Adjustments in one layer force adjustments in others. This creates feedback. As price begins to move, some participants are forced to reduce exposure, not because their thesis has changed, but because their risk parameters have been breached. That reduction adds pressure. The next layer responds. The move accelerates. Importantly, this is not a disorderly process. It is mechanical. The system is doing exactly what it was designed to do under constraint: protect itself. The problem is that the design assumes time. When time is removed, protection becomes amplification. This is why the market appeared unprepared. It was not that participants misjudged direction, they misjudged speed. The assumption was that any adjustment would occur over sessions, not hours. That assumption proved incorrect. Once positioning begins to unwind under compression, narratives lose relevance. Explanations arrive too late to influence behavior. The only variable that matters is whether exposure can be reduced without further destabilizing the system. Silver's 2-hour repricing suggests that many participants reached that question simultaneously. Another subtle but important point is what did not happen. There was no extended halt, no visible breakdown. The market absorbed the move and continued trading. That resilience is often cited as evidence that nothing fundamental occurred. That interpretation is incomplete. Resilience does not mean readiness. It means the system survived the test. But survival under compression often leaves scars. Positioning is lighter afterward. Liquidity is more cautious. Risk tolerance is reduced. These changes persist even when prices stabilize. For professionals and researchers, this is the key takeaway from this phase. The repricing was not just a moment of volatility, It was a repositioning event. It forced the market to reassess how much exposure it could safely carry under conditions where speed itself becomes the constraint. To understand why these after-effects matter and why they can influence future moves long after the initial shock, we need to examine how confidence and liquidity behave once positioning has been forcibly reset. Presses adjustment into hours, the market does not simply return to its prior state. The visible volatility may subside, but the internal reference points have shifted. Participants recalibrate how they engage, not because they expect another immediate move, but because they have learned something about the system's limits. This is where the consequences of the 2-hour repricing begin to matter. After the move, liquidity did not disappear, but it became more conditional. Participants remained active, yet less willing to absorb imbalance without compensation. Quotes were offered, but with greater sensitivity to size and timing. The market functioned, but with a narrower margin for error. This is a common outcome of compressed adjustments. When the system demonstrates that it can move faster than expected, participants stop assuming that time will always be available. Risk management shifts from optimization to preservation. Exposure is carried with more caution. Optionality becomes more valuable than conviction. Silver's structure magnifies this behavioral shift. Its paper market can rebuild exposure quickly, but confidence in doing so is slower to recover. Physical constraints, even if unchanged, loom larger after a repricing because participants have seen how quickly conditions can tighten. This changes how information is processed. Data that once would have been ignored now attracts attention. Small changes in spreads, inventory reports, or delivery behavior carry more weight. The market becomes more sensitive not because it is unstable, but because it is operating closer to its tolerance threshold. Importantly, this phase often produces misleading calm. Prices may consolidate, volatility may compress. From the outside, it appears as though the event has passed. Internally, however, behavior has adjusted. The system is more alert, less forgiving, and quicker to react. This is why the market's apparent readiness can be deceptive. Readiness is not measured by the absence of volatility. It is measured by the ability to absorb stress without altering behavior. In this case, behavior has already changed. The 2-hour repricing forced a reassessment of speed risk. It demonstrated that assumptions about gradual adjustment cannot be relied upon under all conditions. That lesson does not fade quickly. It influences how future positions are sized and how aggressively liquidity is provided. For professionals and researchers, this is the critical insight. Events like this redraw the boundaries of what is considered plausible. They expand the range of outcomes that must be accounted for, even if those outcomes do not materialize immediately. Silver's recent behavior suggests that the market is now operating with a revised map. The terrain has not changed, but the perceived hazards have. That perception shapes every decision that follows. To complete this analysis, we need to examine what ultimately determines whether this repricing remains an isolated stress event or becomes a reference point that reshapes how silver is valued and traded going forward. The most important outcome of a 2-hour repricing is not the price level that follows. It is the lesson the market absorbs about itself. And that lesson is rarely acknowledged openly. Silver's violent repricing did not signal collapse, it signaled exposure. It revealed how quickly assumptions about liquidity, positioning, and time can fail when confidence narrows. The market did not break, but it was forced to adjust faster than it expected, and that experience does not disappear. What the market learned is that speed itself is now a risk factor. Participants discovered that positions built for stability can become liabilities under compression. They saw that liquidity, while present, is not guaranteed to appear on their preferred terms. They experienced how quickly optionality can vanish when too many actors attempt to adjust simultaneously. This learning reshapes behavior long after volatility fades. Going forward, silver will not be evaluated solely on supply-demand narratives or macro themes. It will be evaluated through the lens of how it behaves under stress. How fast does it move when tolerance breaks? How quickly does liquidity retreat? How much price adjustment is required to restore balance? These questions now sit closer to the surface. That does not mean another repricing is imminent. Markets can operate under revised assumptions for extended periods. but it does mean that the threshold for reaction has shifted. Less pressure may be required to produce meaningful movement, not because the system is weaker, but because it is more alert. This is why the market was not ready, not because it lacked information, but because it underestimated how quickly structure could assert itself over narrative. The repricing forced recognition that silver is not just a volatile commodity, but a market where abstraction, leverage, and physical reality coexist uneasily. For professionals, academics, and researchers, this is the enduring takeaway. The event should not be cataloged as a crash, a panic, or an anomaly. It should be treated as a diagnostic. It tested the system's ability to absorb adjustment smoothly. The result was clear. Silver moved faster than the market's framework anticipated. Whether this episode becomes a footnote or a reference point will depend on what happens next. If liquidity broadens and confidence returns unconditionally, the repricing will fade into history. If conditionality persists, it will be remembered as the moment the market realized its margin for error was smaller than assumed. Either way, the signal has already been delivered. If this analysis helped clarify why speed, not just direction, matters in modern markets, consider sharing it with others who study market structure rather than headlines. And if you are observing similar compression dynamics in other assets, credit, currencies, or energy, add your perspective in the comments. These patterns rarely occur in isolation. Markets do not warn before assumptions fail, they demonstrate it.